Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right. Good afternoon, everyone. It is 4:30 here in New York, and welcome to this afternoon's webinar. Today's session will be hosted by Steve Misic, who will cover using ETFs and options for sector rotation. A bit of info about Steve. He's been trading since 1990, and his experience is broad-based, actively trading equities, futures, forex, and options. Steve is a licensed Series 3 commodities broker, Series 7 securities broker, and holds his NASDAQ Series 63 license. He was the assistant head trader for the R&J Financial Hedge Fund. Steve also spent time at the Chicago Board of Trade, where he was employed as a currency strategist for FX Chicago. And for those of you who are wondering, the session will be recorded and available for playback on ise.com/archives within a few days. Without further ado, we're going to go ahead and turn it over to you, Steve.
Well, thanks, Katrina. How you doing, everybody? Thanks for taking some time out in your busy day to come and join us at our webinar for the International Securities Exchange. I'm proud to be here. Been here for a few years now doing presentations mostly in the currency markets. So this one's going to be a little different. We're going to talk about exchange-traded funds and using them for a strategy called sector rotation. And the Online Trading Academy, which is the place that I teach for, and mostly I do live classes. I used to do quite a few online classes like the one we're having right now. I just like getting out and talking to people at the different branches that we have around the world. Last year I spent quite a bit of time in Dubai and Abu Dhabi. If you ever get a chance to go there, I really strongly recommend it. It's just great. I'm looking forward to spending some time in some of the other centers overseas too, Hong Kong, for example. And I am one of the instructors who teaches various classes, stocks, options, futures, currencies, and you can always, if you're interested, get more information about the Online Trading Academy from our website, tradingacademy.com. And if you can attend a live workshop in a center that's located close to your area, there's a live power trading workshop, 4-hour presentation where you'll get a lot of information on our school and what we offer. So let's jump right in with what we're going to talk about today, which is what are sectors. And sectors are really a broad category. There's economic sectors. Today I happened to listen to the news earlier this morning, and they were talking about payroll in the private sector. So sometimes you'll hear the government refer to different sectors, and there's actually 12 economic sectors. And most of the economic sectors that are covered in the 4 major sectors, which are the primary economic sector, and that's companies that operate in extraction of products from the earth, natural products from the earth, such as agriculture, mining, forestry. Then you have the secondary economic sector, which is processing, manufacturing, construction. Then you have your tertiary economic sector, which provides services such as the retail sales, entertainment, and financial services. And quaternary economics sector is made up of intellectual pursuits like education. So the economy has a bunch of sectors, and of course we have businesses that are involved in those sectors as part of the stock market. So for example, we have industries that are linked together. Companies are linked together for comparison purposes, and most investors will link equities into categories such as healthcare, energy, technology, utilities. As you can see, we have the basic material sectors, which includes chemicals, energies, metals, mining. We have the consumer goods sector, which includes industries such as automotive, consumer durables, consumer non-durables, food and beverage, tobacco. And of course, our financial sector has the banking industry, the financial services industry, insurance, real estate. Healthcare is broken down into industries such as drugs, healthcare services, insurance providers. And then we'll also have services sector, diversified services, leisure, manufacturing, retail, specialty retail, transportation sector, we have wholesale trucking, and we have other industries that make up each one of these different sectors. And of course, a sector refers to a large segment of the economy, while the term industry pretty much describes a more specific group of companies or businesses. So on this next slide, you can see that there's the basic material sector, conglomerates, consumer goods, financial, healthcare, industry goods, services, technology, and utilities. And these are the 9 major sectors that make up the market that you'll probably hear a lot of people talk about when they talk about trading the economic cycle. But you can also go a little bit further. For example, in the consumer goods, you can have what we call the subsector section, and you can have appliances, auto manufacturers, auto parts, all different kinds of beverages, including wineries and distilleries, soft drinks, cigarettes, cleaning products. So as you can see, the sector category can be very, very broad, which means, of course, it's a little bit of a challenge to try to put together some kind of a strategy to be able to trade when you're dealing with that many sectors and subsectors. So some of the terminology that's very popular when we talk about sectors are portfolio managers overweighting certain companies in the sector and in their portfolio to try to increase the expected returns of their portfolio. And other portfolio managers will underweight certain securities because the industry, the sector, or the company is expected to lag even the overall market or other companies within that specific sector. A company that's cyclical is a business that is subject to the peaks and valleys at the different stages of the economic cycle. And then you'll have what we call a secular or defensive sector, and these will be companies that are expected to remain stable during the business cycle because people will still need to purchase products like food and toothpaste and toilet paper and other staples, okay? Equal weighting is referring to an ETF that takes every stock and simply gives them an equal allocation regardless of the size of the market cap, and that results in a more balanced portfolio. For example, one of the different ETFs that's attempting to be more or less equal weighted these days is RSP, which is an equal weighted S&P 500 exchange traded fund. And for 10 consecutive quarters right now, up until this last quarter, which we haven't got the results yet, RSP has outperformed the SPY, which is the major exchange traded fund for the market cap spiders. So sector rotation. It's a strategy that you can use to shift money from one sector to another to take advantage of either economic cycles, possibly calendar cycles, and possibly nowadays, especially putting some money into the international companies and taking advantage of their economic cycles. So professional money managers, ever since the 1850s, actually have been using some kind of a strategy to where they will rotate money into these sectors to take advantage of the economy, because certain sectors respond to falling interest rates while others respond to rising interest rates. Retail is one of those calendar type of sectors that actually responds to specific shopping times of the year, such as the Christmas holidays or possibly the back-to-school season like we're having right now. So professional money managers have taken advantage of this. For the most part, retail investors haven't really participated in as much in this strategy as is possible, and with this strategy actually expanding by adding internationals, global sectors, being able to take advantage of long and short strategies with the market the way it is these days. Sector rotation is actually going to take on a lot more new meanings, and there's going to be a lot of different ways to participate in sector rotation going forward. There's 4 stages of the economic cycle, and there's also 4 stages of the stock market cycle. So, for example, we have a full recession, and during the full recession, the news is pretty bad. Consumer sentiment is usually very bad. And it's usually at that time, because the stock market looks forward 6 to 9 months, that you'll see the stock market actually start to bottom. And usually when the stock market bottoms, you start to see money flowing into the transportation sector, You'll see money flowing into the technology sectors and sometimes into the financial sectors, especially if that sector happens to be as beaten up as our financial sector was in this last market cycle. So sometimes financials will actually start to participate in the market, turn around towards the end of the cycle. But if they happen to be as beat up as our financial sector was, there were many, many stocks in the financial sector with this last market cycle that were actually up several 100%. During an early recovery, when the stock market begins to rally, you'll see money shifting into the industrial sectors, basic materials, and usually the energy sector, because rising interest rates, again, will start to attract money into sectors that participate and benefit from rising interest rates. You can also put precious metals in there as an inflation hedge. A little bit later on in the cycle, you'll start to see precious metals pick up. And interest rates are usually going to be rising during this later recovery. The Federal Reserve is going to be raising interest rates to try to slow the economy down. You'll see money start to flow into the staples and services sectors. And you'll hear a lot of good news. You'll hear companies reporting great earnings. A lot of that's been happening again because this particular cycle that we've had, a lot of our companies have gone overseas and, of course, have opened up businesses and are trying to take advantage of the rising consumer sentiment and also the rising middle classes that are starting to appear in some of these overseas countries. So a lot of our companies right now have done very, very well, even though our economy is still pretty slow. And then you get your early recession, where your stock market will begin to decline. Rising interest rates are going to cause the economy to slow down. It's going to choke off credit, and businesses will all of a sudden react and respond to the slowing of the economy by beginning to cut costs. Unfortunately, that usually means laying people off, scaling back on their plans for expansion. We have something called a yield curve, which is usually flat at this point or inverted. You'll hear a lot of people talking about how a yield curve that's inverted is usually predicting the next recession. And you'll start to see companies in the utilities and the precious metal sectors once again do well. And not every cycle, though, is going to go exactly like you see on this slide or on this next slide. There is a chance with this next slide that we may not be coming out of a trough like everyone is predicting we are. There's a chance, of course, we're talking about possibly in the U.S. having a double-dip recession, which is very, very rare because we've only had one of them in the history of the United States. So this slide, which I always like to show every time I talk about currencies, commodities, it doesn't matter. Sectors that those stocks belong to are going to respond during different parts of the economic cycle. And as you can see here, we have the yellow. And when you see the yellow here, we're talking about the economic cycle. And you can see how the economy goes from to the bottom, or what we call a trough, to an expansion, followed by a peak, followed by a contraction. However, way before the economy even starts to bottom, because the stock market anticipates what's going forward and what's going to happen going forward, we begin to have an expansion in the stock market. So most of the times, investors will miss this turn because they're making money shorting. Buying dips is not the way to go during a recession. Usually shorting rallies is the way to go. And so at the turns down here at the bottom and usually up here at the top, the news and everything will have people convinced that the economy is going to continue to roar forward. And down here, of course, all the news will be very, very bad. And so people will be afraid to try to jump into the equities markets because they're afraid of trying to pick a bottom or catch a falling knife. And so a question came up here about what is the definition of a double-dip recession. Basically, a double-dip recession would be where our economy really starts to have another recession shortly after the previous recession has ended. And our last recession was officially declared to be over, so the possibilities of double-dip recession, where the National Labor Relations Board declares that we're having another recession is a very strong possibility. You'll actually hear that from the National Bureau of Economic Research if one is declared. So recession is considered 2 quarters of negative gross domestic product. At this moment, we haven't had even 1 quarter of negative gross domestic product. But at this point in an economic cycle, folks, we're usually looking at the gross domestic product in the 4 or 5% area, and we're barely chugging along at 2. So if we do have a couple of negative quarters, then we'll officially have a second recession very shortly after the last one. So as you can see here, number 8 and number 4, which is transportation and financials, followed by number 5, which is technology, and number 7, which is capital goods. These are usually the sectors that respond to the turn in the economy the quickest. And back in last end of the last recession that we had and the end of the last bear market we had in 2009, some of our stocks such as the railroads, Apple Computer, most of the other technology stocks as well, and a lot of the financials that were very, very beaten up, they turned the corner pretty quickly in March, and we had a very sharp rally off those lows. And as a matter of fact, before you knew it, we were up over 20% in a very short period of time, which right away is, again, a little bit unusual. So another slide here showing what happens to consumer expectations. During a recession, you have reviving consumer expectations. During a recovery, consumer expectations begin to rise. During a full recovery, all of a sudden, consumers begin to fear that the economy is going to top out. And during an early recession, they'll start to fall sharply. Industrial production will begin to bottom out. It'll be rising during an early recovery, flat during a full recovery, and falling during an early recession. You start to see interest rates in a full recession falling. The Federal Reserve will be cutting interest rates, provided they have the ability to do so. As you've all probably guessed, the only thing we can do right now with interest rates as close to zero as they are is to do something called quantitative easing to try to stimulate the economy. Okay. You'll see interest rates begin to bottom out as the Fed switches from cutting interest rates to beginning to raise interest rates. And as the economy is moving along, they'll raise interest rates rapidly to try to slow the economy down. This is happening in certain parts of the world, such as China right now and India, which has been raising interest rates because they do have an inflation problem. And then your yield curve will be normal during a full recession. It'll be a little bit on the steep side during an early recovery. It'll start to flatten out during a full recovery, and then it'll begin to invert as we get close to the beginning of a recession. And another one of the slides that I like to show every time I talk about the economic cycle is the phases of the market. And on this particular slide, these gentlemen actually added a couple of extra sectors to the mix. They also start to talk about the telecom sector as a separate sector from the technology sector. So in addition to the 9 sectors that everybody talks about that we like to view, there are other sectors that are being added in depending on who happens to be looking at the economic cycle and who happens to be talking about the economic cycle. We have financial technologies, consumer discretionary, according to these folks, at the beginning of a cycle. We have materials, industrials, energy, and there's the telecom sector. So these folks do weight the telecom sector as a separate sector from technology. And then we have healthcare, staples, and utilities, which we call the defensive bear market sectors, which tend to go up when the market and the economy is slowing because people will rotate money, professional money managers will rotate money into places they feel are safe. So I made a 2011 comparison slide using my platform of all the different sectors that we have right now. And as you can see, the home builders, which I happen to add, XHB, the home builders exchange traded fund, and financials exchange traded fund, are negative the most as of earlier this morning before today's market action, followed by the XLI, the XLK, the spiders, And the sectors that are actually positive so far are your energy sector and your consumer staples sector. And you've got your technology sector negative as well. So this particular economic cycle that we're having, which recently has had a lot of volatility, has seen a lot of the professional money managers rotating out the growth sectors and putting their money more into the sectors that they deem to be safer. Okay, so we've seen a lot of rotation out of our traditional growth sectors and into our traditional safe sectors. So some of the bull market facts that you'll find in sector rotation. During an overall stock market rally, the early sectors, the sectors that tend to turn first, such as financials and technology, will outperform the broad market. So you're always going to find exchange-traded funds and equities, individual equities, that will outperform the indexes at the beginning of a new bull market. And even though in a bear market sector, we'll have sectors that will rally, such as the defensive ones that we talked about, which would be your utilities, recently doing very, very well because people are, again, putting money into what they consider to be safer sectors. And precious metals have been in a long bull market trend and have done extremely well recently due to the lack of faith in paper money. So even though we don't have official inflation, and I say official inflation because the Federal Reserve, people from the Federal Reserve, including a gentleman who was on CNBC just the other day, said that the Federal Reserve had no responsibility for the rising commodity prices that we've had. And yet the price of gold hit $1,900 an ounce. So normally that sector performs well when we do have inflation, but because people have lost faith in all the currencies, the euro, the dollar, and most of the other currencies, gold has done extremely well. And once again, for safety purposes, U.S. sectors have outperformed the foreign sectors and the global sectors recently, even though we've had a downgrade of the U.S. debt. Some of the bear market facts, and one of the reasons why you should probably think about practicing some kind of sector rotation strategy, and we'll talk about specific strategies towards the end of the presentation. Depending on your age, avoiding a bear market is the major reason to practice a sector rotation strategy. And a bear market is defined as a drop of 20% or more in the overall market. And just in the last month, even though today we had about a 2% rally in Germany, they're down almost 20 plus percent. So they're in a bear market. And that happened in just 1 month. And this economic cycle is different from prior economic cycles because we have the continuing problems from the credit crisis, and now we have the sovereign debt crisis, both here and in Europe. And so we go back and forth from people being very, very afraid, very, very defensive, and therefore the defensive sectors, healthcare, consumer staples, utilities, this early in the market cycle are responding well because people, again, are afraid of that possibility of a double-dip recession. Now, these facts are even worse. A typical bear market occurs about every 5 to 6 years and results in losses of between 35 and 45% on average. The bear market from 1929 took about 25 years to reach break even. And we've had, in the last 80 years, 3 what we call secular bears, which are longer-term bear markets, lasting a total of 48 years. And I always kind of mention that the last secular bull market that we had from 1982 to 2000 was about an 18-year bull market. And so many, many people that talk about secular bear markets are saying that this bear market that we're having should possibly last just as long, which would take it from 2000 to about 2018 or 2020. And what we don't need to see, and what unfortunately with the speed of the last little bear market we had, is a ultra bear market. From 1973 to 1974, we had a 48% decline in major averages. 2000-2002 was 49%, and 2008 was 48%. And at the worst, in this little mini crash that we've had recently, we got very, very close to minus 20% in the S&P 500. We're very close to bear market territory. A secular bear market is a bear market which usually continues until the price-earnings ratios reach single digits. And bear markets generally end when the price-earnings ratio reach single digits. So this particular slide, which is current as of a few weeks ago, shows that industrial sector in 2009 had 6.42 as the price-earnings ratio, which was, again, single digits at the end of that bear market we had from 2008 to 2009. And then it snapped back to about 17.75. Currently, though, we see it declining once again to about 12.81, which is a loss of almost 5% since 429. So very, very rapidly, we've once again started a descent in our price-earnings ratio in all its sectors that make up the major sectors of the S&P Select Spiders. And that's not good. We're still at 12.8 and 12.28 on materials, 11.19 on energy, 10.62 on financials. For this secular bear market, which is projected to last until 2018, 2020, we will be expected to see single digits once again on these price-earnings ratios, which means that professional money managers will not be willing to pay up for high-priced, very expensive stock.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.